Integra LifeSciences, ticker IART, just released their Q2 2026 earnings, and they delivered a definitive beat on the bottom line.
Yeah, a really solid beat.
Right, so adjusted EPS came in at 56 cents, which actually exceeded the top end of their own guidance.
Yeah.
I mean, that is a massive 24.4% jump from the prior year.
And, the market noticed shares jumped about 4% in the pre-market right after the print.
Exactly. Now, on the top line, reported revenue hit $419 million. That landed squarely within their guidance range, representing 0.8% growth reported and 0.7% organically.
Which is, practically flat.
Yeah, very flat. And looking at the rest of the year, management reaffirmed their full-year organic growth of 0.8% to 3.3%, and they maintained their adjusted EPS guidance at $2.40 to $2.50.
But they did trim the reported revenue range slightly downward.
They did.
Yeah.
Yeah. They're now expecting $1.654 billion to $1.695 billion for the year.
So if you are a retail investor digesting this report right now, the immediate high-level takeaway is that this is a classic execution story. What we are seeing is a company that effectively held its revenue steady despite facing some very real macro headwinds.
Yeah.
But they managed to squeeze significantly more profit out of those exact same sales. That bottom line beat is the core narrative of this quarter.
Okay, let's unpack this, because getting a 24% profit jump on what is essentially flat revenue is an impressive mechanical feat.
It really is.
It's like, imagine a retail store where the daily foot traffic hasn't changed at all in a year, but somehow the cash register is showing 24% more profit at the end of every single day.
Right. You either dramatically raised your prices or you negotiated a much better cut from your suppliers on every single item.
Exactly. Funneling that extra efficiency straight into your pocket. So how exactly did Integra pull off that magic trick this quarter? We have to look at the engine room.
Margins.
The margins, exactly. Adjusted gross margin ticked up 60 basis points to 61.3%. But the real star here is the adjusted EBITDA margin, which jumped a very impressive 160 basis points, landing at 18.7%.
And that 160 basis point jump in EBITDA margin is where your retail analogy really comes to life.
How so?
Well, management explicitly attributes this profitability spike to three underlying drivers. They cite internal margin improvement initiatives, a more favorable product mix, and structural cost outs.
Wait, I want to stop you right there because, structural cost outs and margin improvement initiatives are classic corporate buzzwords.
Oh, absolutely. They look great on a PowerPoint slide.
Right. But what do they actually mean on the ground? Are they just firing people? Or is there a fundamental change to how this business operates?
It actually is a fundamental change to how they operate, and you can see the financial evidence of it if you know where to look in the report.
Okay, where are we looking?
If you scroll down to the reconciliation tables, the part of the release where they bridge their accounting numbers, you can see a massive gap between their GAAP net income and their adjusted income.
Right. GAAP was just $4.5 million and adjusted was $43.7 million.
Exactly.
That is a nearly $40 million difference. So what is making up that gap?
Well, a huge chunk of that difference is directly tied to structural optimization charges.
Okay.
And the costs of transitioning their manufacturing footprint. So what this means in plain English is that Integra is actively spending cash right now to consolidate their operations.
Cutting down inefficient facilities, that sort of thing.
Yes, shutting down facilities, streamlining their corporate structure. They are basically absorbing short-term pain, which hits that GAAP net income number
Right.
to permanently lower their ongoing cost of goods sold. They are literally paying money to get leaner.
And when you combine that leaner cost structure with a favorable product mix, meaning they just happen to be selling a higher volume of their most profitable items this quarter, that extra efficiency flows straight down.
Straight to the bottom line, giving you that 24% EPS jump.
It is the classic strategy of spending money to save money long term, and you can see the immediate tangible reward for that efficiency when you look at their cash flow metrics.
The cash flow was huge.
It was. Operating cash flow for the quarter didn't just edge up, it surged to $22.8 million.
Which is a massive jump.
Yeah, if you look back to exactly a year ago in Q2 2025, that figure was just $8.9 million. So they aren't just creating accounting profits, they are converting that margin expansion directly into hard liquidity.
Right, hitting an adjusted free cash flow conversion rate of 24%.
Exactly.
What's fascinating here is how that ability to generate hard cash completely changes the company's defensive posture.
How do you mean?
Well, we are going to talk about their debt load and interest rates a bit later, but when you are operating in a higher interest rate environment, generating your own cash is the ultimate strategic advantage.
Because you aren't at the mercy of external financing.
Right. You don't have to go to the credit markets to fund your daily operations or, pay for those facility transitions we just talked about. You are self-funding your own turnaround.
Okay, here's where it gets really interesting, though. Because that top-line reported revenue number of $419 million isn't a single uniform block.
No, definitely not.
It's actually hiding a very stark contrast between Integra's two main operating divisions. Let's lift the hood on the revenue mix, starting with the workhorse of the company, specialty surgery.
Right. The segment that makes up about 70% of their total revenue.
Exactly. It brought in $309.3 million this quarter, growing organically at 1.6%.
And if you break down specialty surgery even further, you see some distinct crosscurrents.
Like what?
Well, the neuro business was very strong, up 1.9% organically. Management noted that was driven by highly specific demand for core products.
Products like Certus Plus, the CUSA tissue ablation systems, and Bactisel.
Exactly. Then you have instruments, which also had a solid quarter, growing 3.2%.
Though management did point out that the growth in instruments was largely due to favorable order timing.
Right, meaning some orders just happened to fall into this quarter rather than the next.
Okay, so neuro is up, instruments are up. Was there a drag on the segment?
Yeah, the drag was in the ENT, or ear, nose, and throat division. That saw a slight decline. They had some decent growth in their microfrance instruments, but it simply wasn't enough to offset declines across other ENT product lines.
But taking it all together, specialty surgery remains a very stable, net positive contributor to the top line.
Definitely, it's the anchor.
But then we pivot to the other 30% of the business, tissue reconstruction. This segment brought in $109.5 million, but it actually posted an organic decline of 2.0%.
Yeah, that one looks tough on paper.
It does, and I had to push back here. Because if you are a shareholder reading this report, you are probably scratching your head right now.
Because of all the positive product callouts.
Exactly. Management spends a lot of time highlighting that the Durasorb product grew strongly. They note that the PriMatrix product was successfully relaunched.
Yeah.
They even call out the private label subsegment as being up 4.7%. So explain the math to me. How does the overall tissue segment shrink by 2% when so many of its individual high-profile pieces are apparently growing?
What's fascinating here is that if we connect this to the bigger picture of corporate accounting, you run headfirst into a concept known as a noisy comp, or a noisy comparable.
Okay, walk me through that.
To understand why Q2 2026 looks like a decline, you have to completely ignore this quarter for a second and look at exactly what happened a year ago.
Okay.
In the second quarter of 2025, Integra managed to finally clear a massive backorder of one of their key products, Integra Skin.
Let's break down the mechanics of a backorder. What does that actually look like for the revenue numbers?
Think about it like a dam bursting. For months prior to Q2 2025, they had supply chain issues.
Right. Hospitals were placing orders for Integra Skin, but Integra couldn't ship the product.
Exactly. So all that potential revenue was just building up, waiting. Then in the second quarter of 2025, they fixed the bottleneck.
And they shipped a huge pent-up wave of product all at once.
Yes, to fulfill those delayed orders. From an accounting perspective, they recognized months and months of delayed revenue all in one single quarter,
Creating a massive artificial spike in their Q2 2025 sales.
Exactly.
I see. So when we look at Q2 2026 today, it's not that customer demand suddenly dropped off a cliff.
No, not at all. It is a mathematical artifact. You are comparing a normal, healthy run rate quarter today against an artificially inflated, dam-bursting quarter from the prior year.
Right.
The underlying demand for wound reconstruction solutions is actually quite healthy, which is exactly why you see Durasorb and PriMatrix growing.
But that underlying growth gets completely masked by the backorder clearance in the year-over-year comparison.
Precisely.
That perfectly highlights why supply chain issues are so frustrating for investors. I mean, they don't just delay sales, they completely distort how a company's growth trajectory looks on paper for an entire year afterward.
It creates a lot of noise.
It does. And fixing those supply chains brings us to the company's biggest operational focus right now. CEO Stuart Essig made a very specific point in his commentary.
Right, about supply reliability.
Yes. He stated that the mission right now is, improving supply reliability, advancing quality, and returning products to market with discipline.
And if we translate that corporate speak into a specific operational catalyst for you to watch, it means pointing a spotlight directly at the Braintree manufacturing facility.
Because the earnings presentation officially confirmed that the Braintree facility is now online and actively producing inventory.
Yes, it
So
is.
let's dig into that. Improving supply reliability is a great soundbite. But what does bringing this specific facility online actually mean for the operations of the company?
It represents a massive psychological and operational shift for the entire organization. For the last several quarters, Integra has essentially been stuck playing defense.
Because of the quality system issues.
Exactly. When you have quality system issues in medical technology, it paralyzes you. You have to update standard operating procedures, retrain staff, pass rigorous internal and external inspections.
Validate every single piece of manufacturing equipment.
It is a grueling, expensive process.
Which explains all those structural optimization charges we talked about earlier.
Precisely. But bringing Braintree online means that defensive phase is ending. They are now transitioning back to playing offense.
Okay.
Specifically, they are using Braintree to actively stockpile inventory to support the highly anticipated relaunch of SurgiMend.
Which management continues to target for the fourth quarter of 2026.
Yes, they do.
So why is SurgiMend the linchpin here?
Because SurgiMend is a flagship product in their tissue portfolio. It's used in complex procedures like hernia repair and plastic surgery.
Okay.
Getting it back into the hands of surgeons is the critical pivot point for accelerating their overall top-line growth. They couldn't do that until the manufacturing foundation at Braintree was absolutely rock solid.
So the narrative here is that they spent the last year taking their medicine, fixing the engine, and now they are finally preparing to step back on the gas in Q4.
That's exactly it.
Okay, so the margins are expanding, the supply chain is stabilizing, Braintree is online, and the SurgiMend catalyst is locked in for Q4. But that brings us to the most perplexing part of this earnings report.
The guidance cut.
Yeah. We noted right at the top of the deep dive that while management reaffirmed their full-year EPS guidance, they actively lowered their reported revenue guidance.
Down to that 1.654 to 1.695 billion range.
Right. So if the underlying business is executing so well, what is threatening the top line? Like, why lower the reported revenue guidance at all?
Because no matter how well a company executes internally, it cannot outrun macroeconomic gravity.
Okay, macro headwinds.
Yeah, the primary culprit forcing them to trim that reported revenue range is foreign exchange. We are currently operating in an environment with a very strong U.S. dollar.
Let's walk through the mechanics of that for the listener. How does a strong dollar actually erase revenue?
Well, think about Integra's international operations. When they sell a medical device to a hospital in Europe, that hospital pays in euros. When they sell to Japan, they collect yen. The actual number of units they are selling might be perfectly stable or even growing.
Because the underlying demand hasn't changed.
Exactly. But when the end of the quarter comes, Integra has to translate all those euros and yen back into U.S. dollars for their earnings report.
Right, and when the dollar is exceptionally strong, a euro buys fewer dollars.
Yes. So the exact same volume of international sales simply translates to less reported revenue on paper. It is a macro reality that multinational medtech companies simply have to absorb.
Okay, I get that. But there is a second headwind baked into their guidance, and this is where geopolitics directly collides with the balance sheet. Management highlighted a very specific business risk regarding tariffs on U.S. exports to China.
Yes, and they quantified exactly how much it's going to hurt.
Right, the guidance includes the impact of a 14% tariff applied on U.S. exports to China.
These include the Section 122 tariffs, which applied through July, and the recently enacted Section 301 tariffs that will be applicable for the balance of the year.
And management explicitly stated they expect these China tariffs to take roughly a 10-cent bite out of their full-year adjusted EPS.
Which is significant. 10 cents a share is a meaningful hit to profitability.
It really is. And this raises an incredibly important question about their leverage risk in the face of these external pressures.
Let's zoom out to the balance sheet.
Yeah, when you look at their balance sheet, Integra is carrying $1.6 billion in net debt. That leaves them with a consolidated total leverage ratio of 4.1 times.
Right.
Now, for you, the retail investor, a leverage ratio of 4.1x essentially means their total debt is just over 4 times their annual EBITDA. We are operating in a persistently higher interest rate environment right now.
And the company has explicitly noted potential debt refinancing actions coming in the second half of the year.
Exactly. And when your leverage is over 4 times, any refinancing you do is likely going to happen at a higher interest rate than your previous debt, which can severely pressure your bottom line.
It is a critical risk factor, and it's exactly why we spent so much time earlier talking about their ability to generate free cash flow.
Ah, it ties back.
It does. When you have 4.1x leverage, you want as much internal cash generation as possible so you aren't forced to borrow even more at these elevated rates just to run the business.
That makes perfect sense. But I want to highlight a truly fascinating detail about management's financial maneuvering in response to this debt risk.
What did you catch?
The earnings presentation explicitly notes that tariff favorability is being used to offset potential incremental interest expense in the second half of the year.
Wow. That is an incredibly sophisticated lever for a management team to pull.
Explain the mechanics of that. I mean, how do you use tariffs to hedge against rising interest rates?
It basically comes down to actively managing your global supply chain to optimize your liabilities. While the China export tariffs are a known negative headwind, Integra operates a massive global distribution network. So, by slightly shifting where certain products are manufactured or how they are routed through various international distribution hubs, they can manage other global tariff dynamics favorably.
Ah. So what management is signaling to Wall Street is that they have engineered enough savings on the global tariff front to act as a direct, dollar-for-dollar financial hedge against the rising interest costs they expect from refinancing their debt.
Exactly.
So they aren't just sitting back and letting macro forces dictate their margins. If they know interest expenses going up, they're finding equivalent cash savings deep within the supply chain to balance the scales.
It demonstrates an incredibly tight level of operational and financial control over the P&L.
It really does.
And that level of control is what ultimately gives investors confidence that the 24% EPS jump wasn't just a fluke.
Right. It was a result of deliberate structural management.
It's
So to synthesize this entire quarter for you, Integra LifeSciences, right now, is a masterclass in bottom-line execution.
without a doubt.
They are expanding their profit margins, they are doubling their operating cash flow, and they are navigating a mathematically noisy year-over-year revenue comparison.
Right.
Most importantly, by bringing the Braintree facility online, they are finally transitioning out of a purely defensive posture and setting the stage for a major product relaunch in Q4, all while actively dodging the crossfires of a strong U.S. dollar and new international tariffs.
And that leads to a final forward-looking thought for you to explore on your own as we move through the back half of the year.
What should they be watching?
Well, when SurgiMend finally does relaunch in the fourth quarter, you need to watch the initial revenue data closely.
Right.
Question isn't whether revenue will spike. I mean, it almost certainly will because hospitals are eager to get a key product back on their shelves.
They've been waiting for it.
Exactly. The real question is this. Will the resulting revenue spike simply be a one-time restocking bump? Or can Integra's commercial organization leverage that momentum to drive sustained multi-year market share growth heading into 2027?
That's the real test.
Yeah, that distinction between a one-time pop and sustained commercial momentum will ultimately determine the long-term trajectory of the stock.
That is the multi-million-dollar question. To make sure you don't miss the answer when Q4 rolls around, hit follow on the show right now for our daily earnings coverage.